It's a simple process. The world is obviously a complex place and we try and simplify it as much as possible. So you start with our universe of 70,000 companies and we screen initially just by size. So we only buy companies that have market caps of above $3 billion. So once we've done that, we then screen a lot of our metrics by risk. So we screen out companies with bad balance sheets, debt to EBITDA of less than 2.5 times. We include those, screen out the other ones. We screen out companies that we think have been growing excessively quickly. Most people screen companies in that are growing too quickly. We actually try and screen out those companies. So those would be businesses whose balance sheets have exploded, who's basically been issuing a lot of shares through time, who've got a whole heap of goodwill on their balance sheets, so we screen those out. We're also looking for good businesses, and for us a good business is one that earns high returns on capital through an investment cycle. So basically we look for businesses that have earned a return on invested capital of 8% over a 10-year period on average. What we don't want are businesses that earn great returns at the top of the market and earn terrible returns at the bottom. So we want consistent returns through a cycle. And then we screen out a lot of industries we're just not interested in. Anything that's leveraged, cyclical, hard to predict, complicated, regulated. And that gets us down to a kind of working list globally of about 200 and 250 companies. To be honest, we haven't changed much through COVID-19. It stayed as it was before. If anything, we've just drilled down more on what we look at. So the balance sheet is crucial. So we put even more stress on balance sheet strength, off-balance sheet liabilities, particularly in places like retailers. Leases are hugely important, and whether you own the property. We've really focused even more on businesses with high margins, high recurring revenues. We're not looking for businesses that, obviously in a recessionary type environment, you don't want low margin type businesses. Cash flow is crucial. We've really drilled down on cash flow as much as possible. I think what COVID has shown us is that the importance of having a simple process that's easy to execute under pressure, because obviously we don't want to be making complicated decisions every day. So our process is simple by design, and that has helped us, I think. We prefer net cash. If you look across our portfolio today, the net debt to EBITDA is 0.5 times across the whole portfolio. And then on one side we have companies like Alphabet, which have 117 billion in the bank. Microsoft has 60 billion. It just puts you in you sleep well at night knowing the balance sheet's okay. If you're in one of the industries, say for example, that's going through balance sheet stress at the moment, and you're having to recapitalize your balance sheet at very depressed valuations, that's a huge destruction of wealth for shareholders. I think the biggest lesson I've taken out of the last 6 months, and every single recession I keep coming back to it, is the importance of a strong balance sheet and a simple investment process. If you own businesses, the way markets were moving in March, if you have a very complicated portfolio with a complicated process, you're having to make a lot of decisions every day. Will we be recapitalizing? Will rates be going up, down? What will the economic conditions be like? All those types of things. For us, if you've got a good balance sheet with high margins, good cash flow, the only decision you really have to make is, have we lost competitive advantage? Yes or no? And is there a better investment we want to buy than the one we already own? And it just helps having a simple process and having good balance sheets.